All right. Welcome to the Big Skinny with me, Basenese. Coming to you on a week where we've got a Fed meeting definitely going to cut. We got big tech earnings. Everyone's wondering if we're in an AI bubble. We got a government shutdown looming, 27 days long in the tooth. Trump 1.0 went 31 days. But guess what? We're not talking about any of that because I'm a glutton for punishment. I like things that are contrarian, out of favor. And guess what? One of those things, biotech, the beloved biotech sector that's made more heroes and zeros out of investors in the long run, is actually staging a comeback, just as we predicted. So we're going to cover that, and we're going to bring a guest in to really help us understand how to build a strategy around that. I'm excited for this interview because this is a great human interest, biotech interest, investor interest story. Jonathan Faison comes to us. This was a guy that was just like all of us, had no clue about biotech. Fast forward 15 years later, he's making a living from his investments here and really making a name for himself because of the type of due diligence he does and the humility that he shows in the process. So looking forward to that conversation. If you're new to this show, though, let me kind of bring you up to speed real quick. We do things a bit differently. We sort through all the noise to distill down what matters. And we do that in a format at the top of our show called The Rundown, where we give you one headline that you should usually ignore because the consensus is very misleading. One key chart that has the data that should guide your decisions, not the opinions. And then we leave you with one investing insight, one specific action to take, because at the end of the day, if we're not helping you increase your bottom line as well as expanding your market knowledge, then we're failing to do our job, because hanging out together is no fun unless we're making money together. And that's really the goal of this program. All along the way, we want you to join the conversation. We're live streaming on multiple platforms, and we're not afraid to take whatever punches you can throw at us, whatever hard questions, whatever criticisms, we encourage them. So join the conversation all along the way. Make this a choose your own adventure show. Try and tip me off, throw me off, get me off my guard, and flatten me like a pancake where someone's got to flip me over with a spatula to get me going again, folks. This is a show that we say random things and you'll find out at the end why. Yeah, that's a little bit of a teaser there. But let's get to this week's rundown before we do anything else. We're having fun in the studio in Brooklyn. I'm making these guys giggle, but here's the thing. Look, don't jinx it, guys. We have a game we're playing. We're not supposed to let everyone onto it, even when I come up with bad terms. But let's not jinx this biotech rally and rebound, right? Wall Street Journal out with a very telling headline that's proclaiming from the rooftops that this rally can last, that the stars are aligned once and for all. And folks, this is big news because we talked about it before. The NASDAQ, the S&P, the Dow, all hitting all-time highs repeatedly this year, last year, the year before. And guess who the laggard was for a while? Well, it was small caps. Those beloved small caps and the Russell 2000 almost took 4 years to hit all-time highs. Guess what still hasn't? It's the biotech sector, the XBI. Now, what is driving this? Is it just an area of the market that's undervalued and unloved, or is there a structural issue at play? Well, I'll tell you this, PitchBook got it right. There's a huge patent cliff looming. The big pharma companies that are in this world are staring down the prospects of losing $180 billion in drug revenue by the end of 2027 and 2028. Now, let me put that in perspective for you. You might not know this, but the world's top-selling drugs really do only about, and I say only, in air quotes, right, about $20 to $30 billion in revenue annually. So $180 billion in revenue is not just one or two drugs. This is literally probably 4 or 5 dozen different drugs that are accounting for all of these revenues, and they need to be replaced. And that's bringing back some good times, so much so the most skeptical voice, but also the shrewdest voice in this biotech sector at Stat News, Adam Furstein, is out saying, man, this feels like the old times. That's right. Don't jinx it, though, because we've had more money and more problems in this area of the market. And if we look at the XBI performance, I alluded to it earlier here, there's no peak yet, right? 2021 during the COVID days was the peak, the last time we saw the XBI break out to a new peak, when there was literally billions of dollars being thrown at new therapies, and every company that thought they might have a scientific approach to treating COVID, pivoted to come up with applications for it or potential ones. But this is the thing, right? We actually had a glut of financings in biotech. I wouldn't expect the biotech sector to have rebound yet, because if you look at this, this is the number of financings for new biotech companies, basically new company formation, went through the roof through COVID, right? So that was just a glut of money, a glut of capital chasing after a lot of opportunities, and many of them proved to be science experiments. But here's what is interesting. We're getting to more mergers, which means more money for us. Today alone, RNA was announced as being acquired by Novartis for $12 billion. Stock's up 42% on the move. If you look the far right of our money chart this week, it shows you that the takeout premiums for biotech companies can be life-changing, right? The average in 2023 was over almost 120%. In 2024, we got to 77%. And this year, we're averaging about 70% buyout premium. So avidity was about 46, but you're seeing across different key therapeutic areas, think cancer, think neurodegenerative diseases, even higher premiums, which makes this ripe for opportunity for us as investors. So let the merger mania continue. As we pointed out before, these companies have to do it because they need to replace it. So what does that mean from the investing insight? Well, here's the big skinny. Buy the SPDR S&P Biotech ETF, XBI. We've talked about this before. This has got more weighting because it's equal cap weighted to the smaller companies in the biotech space versus the IBB. If you know nothing about biotech, this is a great way, and this is a great strategy. We talked about playing trends, is to buy an ETF that's diversified and gives you multiple shots on goal, more mature opportunities, and let that be what leads you into researching and learning more about specific opportunities that then you can take an individual position in. And with that in mind, that's exactly what we're going to talk about next. We're going to talk with Jonathan Faison about how he goes about finding opportunities in this market, where the most upside exists, how you can avoid the risk. So let's get right to it after this quick break, and after you go, hopefully, make us as popular as Mr. Beast. All right, we'll take a fraction of his popularity. Just go follow us on YouTube so you never miss another episode. You'll get reminders via email from us, but then also from YouTube every time we're going live with a new guest that helps us up our game and level up, because we firmly believe that you have to be humble in these markets or you're going to be humbled by these markets. At the same time, follow us on X. Elon Musk said if he did follow us, you should follow us, and I'll take that. Elon innovating. I don't love his company as an investment, Tesla, but I'd love him to follow us, and I'd love for you to follow us along the way. And don't forget to chime in with your questions, comments, and any stocks you'd like us to take a look at. We're live streaming. Fire away when you got your shot. But first, do you like LCTX, Violator 2020? I love, you join all the time. I never forget that handle, Violator 2020. I don't know LCTX, but maybe I'll take a look at it in the break here. And maybe during our special new segment that we're bringing up during the show, Diligence, will show you how I would go looking at a new company. Stephen Vig, what's the Vig? Jonathan, what's your approach? Oh, great question here. I'm going to save this for the next segment, for when we bring Jonathan in. That's directed at him, so we'll let him answer it. Folks, we'll be right back after a short break with Jonathan Faison.
Lou Basenese with me for this hour, and he's got an interesting stock pick. TerraWulf.
Yeah, TerraWulf. Look, everyone is saying that AI is in a bubble. I'm here to tell you it's not, and the real key is not the chips. It's going to be the power supply. TerraWulf, I talked about IREN before, which is my favorite position in this place. This is my second, because the executives here, I interviewed CFO Patrick Fleury. The entire executive team came out of the power industry, not Bitcoin bros that were trying to find a new way to pivot and make money. They know intimately the process required to bring on new data centers and getting the power in place. I really think this is a story where you have to bet on the jockey and not the horse, because their data center capacity is really needed by all the AI players. I think this is a stock that should be trading at about $25 a share based upon their current business with FluidStack and Alphabet.
I'd take that.
Yeah,
a doubling.
I'll gladly take it.
Give it to me, please. Thank you very much. Your other stock pick is Alphabet.
Yeah, Alphabet. Look, remember a day or two ago that Chrome was going to be dead because OpenAI came out with their web browser, and for a millisecond the stock sold off $70 billion and it's bounced back. AI was supposed to eat search. That didn't happen. When Alphabet reports results next week, I believe they're going to assert their dominance again in the AI megatrend. And this is a stock that's up $100 since we last talked about it and recommended it. I think it can go up another 100 from here based upon their AI and just ongoing dominance in that space.
Wouldn't that be nice? So a doubling of TerraWulf and another $100 on Alphabet.
That's what I'm betting on. So,
okay, you're on videotapes. He might hold against you.
All right, welcome back to the Big Skinny. It's time now to really level up our just understanding of the biotech sector. How you, if you've never invested in this space, can get started. I'll confess, I've made some of the biggest gains in my career in this space. And I started out as a tech guy and then backed into the science and understanding. And that is exactly the trajectory of our guest of today's show, Jonathan Faison, who's a veteran now of the biotech sector of 15 years running. Welcome, my friend. How you doing?
Doing great. Thanks for having me, Lou.
Listen, we got a question already from the audience, and I know you're just like me. We love to just jump right into it, so let's do it. So this is coming from Steven. What's your approach to commercial biotech companies versus clinical stage? Ooh, great question here, because I think you do have a different approach to this.
Oh, sure. I like the imagery. There's a movie, Pistol Pete, where the basketball coach holds a ball, and he says, "This ball represents what you know, or the whole of the knowledge of basketball." And then he points to one point on it and says, "This is what you know." And that's how I feel about biotech. I'm very aware as a retail investor what I know and what I don't. And so most of the portfolio is commercial stage biotech. So what's nice with those companies is you're not worried as much about FDA risk because they're already approved drugs. And so you're looking more at sales growth over the next few years. That's going to drive the stock price, as well as pipeline momentum. In general, and again, this is just for my portfolio personally, I have a maximum allowed portfolio weighting rule. So for clinical stage biotech, it's just 5% of the portfolio maximum for each position. But for commercial stage, it can be up to 10%. And again, that's just all about
a starter position, or do you let them grow from there? How do you handle?
They're allowed to grow from there. Exactly. If the share price increases, obviously the amount of the portfolio can as well. But again, the idea is, I love how you said, stay humble or the markets will humble you. And I learned the hard way in biotech, what I call these gut punches, where you'll wake up in the morning and a stock that you thought was going to do very well loses 90% of its value because a study tanks.
Yeah.
And so how do you manage that risk?
Yeah, no, look, we saw an example of that today, right? Nvidia RNA is up 42%, and then Intelia NTLA down 42% on an adverse reaction in I think it was a liver, correct? Right? It was
liver, correct.
Yeah. Yeah, so look, it can humble you quickly. So position size, you had a great tweet before too, is that you basically, the key is, well, actually this wasn't you, but your story has this guy, Matt Gray, that I found, is you got to start somewhere essentially. You don't need to be an expert, and you're living this out. So how did your strategy come out of this, right? So where did you come up with the 5 and 10% portfolio limits? What are the things where you could shorten that learning curve for someone that's listening today that's never invested in biotech? What's the one thing you would say, aside from position sizing, that's most important?
Oh, that's a huge question. And I wish so much somebody had asked me that or told me that when I was, starting out at age 22. First thing I did was invested my life savings and lost half of it during the financial crisis. Thought I was a genius, took out a big loan and lost most of that. And I had to learn everything the hard way. And the number one thing is community, whether you build that on an X with the people you follow, whether like with us, ROTY Biotech Community, we have about 500 investors and traders of different strategies. But wherever you find it, surround yourself by smarter people, those with different approaches, especially if they've been in the markets a lot longer than you. I like to say that nothing that I have in my system is original. It's just taken from people smarter than myself. Even the tier system, having a tiered strategy, 4 different tiers of position weightings from 10% of the portfolio to 7.5 to 5 to 2.5. There's a guy in our chat named Mike who used to manage a hedge fund, and he was telling me how he used tiers. And that's kind of where 1 and 1 clicked, where I realized, oh, that would really help me to make sure I don't rush into positions, that I'm constantly weighing risk reward. There was another analyst who taught me what he calls portfolio cage match system, where he takes a stock he owns and another stock on radar that he might like, and he puts them in a cage match against each other and asks, which one has better risk reward, which one has higher upside, which one has a better balance sheet, better management team. And so each thing in the system is part of a larger whole learned from other people.
Yeah, no, look, I love the community aspect. We were talking before you started the show too, that one of your community members is someone that's in my community from different crosses of life, ER Capital, who is a great early stage microcap investor. And look, I think that's what's different. And this is what I love about you two. You share your wins, your losses, your learnings, your hard lessons, the good lessons. Nowadays on X, I see people, and this is my pet peeve, where they're just tweeting out their portfolio size. And it's like, that's not value added content. Give me something that you learned the hard way, or share an insight, because everyone's learning, especially this community is very tight knit. Wanted to talk to you about, because it is, you've basically got a real-time survey of sentiment from your 500 community members, right? What do you see as the sentiment change in biotech right now? And why do you think that this rally might have some staying power compared to what we've seen, in the recent 3-4 years on every fake out rally?
Sure. That's a great question. And I think I shared in an X post recently, it was only a few years ago where many biotech investors wanted to throw in the towel because of how difficult it was out there. We had what we call the thinning of the herd, where a lot of weaker companies were eventually running out of cash, reverse mergers, or going bankrupt. As you said, with IPOs, at the 2021 peak, the problem was a lot of science projects were coming to the market. Personally, I'm not allowed to invest in science projects, where companies come up with a platform technology and they're throwing it at the wall at different indications and hoping something will stick. For us, when we invest, there has to be a clear path to market, clear differentiation versus other available drugs or peers. And so you're seeing this confluence of positive factors, all these negativity from the past few years is flipping, and now we're seeing M&A activity coming back. It's already at a higher level than last year, still under 2023, but it's getting there. RNA avidity today, as you said, with Novartis, and it's so you're seeing the M&A activity going up. There's a lot of license deals going on. There's a very friendly FDA right now with the regulatory flexibility. The most recent example was Replimune, who has their oncolytic immunotherapy that got a thumbs down for a second time, I think, from the FDA. And they came back around because there was so much pressure from the melanoma doctors who said after PD-1 immunotherapy, these patients don't have many other options except for clinical trials, and from the patients themselves. And so the FDA flipped and assigned them I believe it's a June PDUFA date or January PDUFA date. So it's nice that they're getting a second shot, and most likely will be approved this time around. We're already seeing that flexibility with rare disease companies as well. And so that's really nice, refreshing from an investor standpoint to feel like you have headwinds instead of swimming upstream for a change.
Yeah, no, I completely agree with you. A very just pro-approval FDA. It's funny. Do you ever think? I mean, and I know we'll get questions. My partner here comes on to ask questions later of terminology he doesn't understand. But if you teleported back to 15 years ago, did you think you'd be saying PD-1 inhibitor, immunotherapy? Let's see. But we probably go CD4 cells and Tregs. And how did you get over? Because I think that's the most intimidating thing for new investors. Just the nomenclature, right? The abbreviations. How did you get up to speed so quickly on the different mechanisms and different terminology?
Well, that's a great question. I like to say up to speed is relative. There's still a lot I don't understand, not having the background there. I like to say that if I'm able to explain the thesis, the reason to invest to my 10-year-old nephew in an easy way that he can understand, that means I'm allowed to invest in it. The guys in our chat are smart. The people on X are smart, all the scientists, et cetera, who follow. And they can tell pretty quickly if you're trying to pretend to be something you're not. So if you're reading all of these clinical studies, if you're reading the opinions out there, contrasting them with your own research, listening to the management presentations, there's Jose Reston, who also, he's Peruvian Swiss investor in our chat. And RNA that was bought out this morning was his largest position, 23% of his portfolio before the buyout.
Round of applause for Jose, man. That's a big win today.
And he's racked up 5 buyouts this year. 40% of his portfolio has gotten bought out this year. But what I like about him is, like you said, he just stays humble. He shares why he invests in each company for the long term. He's all about downside risk management. And that's what I love about the community is people are sharing their ideas. They're not trying to pretend to be something they're not. And he spelled the risks out ahead of time. Avidity, who got bought out today, it wasn't long ago, they were in single digit stock price. They had some pretty bad adverse events. It was like basically cerebral hemorrhage, whatever. And so that's one that I steer clear of personally because I did not understand what was the chance of that adverse event happening again.
Right.
So you have to know what you own and be very honest with yourself what you don't know.
Yeah. So look, I think you put a finger on it. It's immersion, right? Just immerse yourself in the language of the sector, start reading, interacting, and you'll pick up the terminology and get an understanding just like you would if you're learning a new language. It's the fastest way. You keep mentioning community, and we've got a lot of people here asking questions, so let's get right to it. Chad, would Jonathan recommend one of your previous ADMA Biologics? Don't know if you ever looked at that before. That is more in the transfusion space outside of XBI. What would your top 5 names and symbols? That's a big ask since he runs a subscription, but I know you got at least one name you can share with us that's high conviction.
I'm happy to share tops. But first, with your question, ADMA, that's not one I personally follow. I've done some due diligence on it. Mike from New Zealand, who's a hedge fund trader in our chat, that's actually his top position. And he likes it for similar reasons. As a cash cow, he thinks it's a target for a leveraged buyout. Personally, I like to say that buyouts are icing on the cake. They're never the center of my thesis. If they happen, it's amazing. Strategic value to acquirer is one of the main selection criteria we use. Also having a long IP runway, patent life. Yeah. But it's nice if it happens. But it is a nice cash cow, and I did see that management's. There's been a lot of insider buying.
Look, I met with those guys maybe 5 or 6 years ago, management team, and they laid out the path that they were going to go on, and they absolutely executed against it. So full disclosure, I don't own it anymore. I wish I held on to it. I took a small profit instead of hanging on with conviction for the long-term game. But what are some of your top names now, and what are the indications that they have approvals in? What stage are they at?
Oh, I love it. I like to, like you said, it's all about value add for the people listening to us. So the most timely name that I would talk about would be Syndax Pharmaceutical, symbol SNDX, currently around a $1.1 billion market cap. The cash on hand is around 500 million. And what's interesting here is they gapped down on the approval of their leukemia drug Revuforj, which is the first menin inhibitor approved. It's already approved for KMT2A rearrangements, which is 5 to 10% of AML, and it just got approved for NPM1. So the two of those combined end up being around 50% of AML cases. And the gap down is due to some safety concerns that aren't new to my eyes. But before they had QTC prolongation, which is on the label. And then they've had differentiation syndrome, you name it. But people forget the context of these drugs in the relapse refractory setting, especially these mutations. It's, in KMT2A, these patients have 3 months of overall survival. So you're able to give them, with no drugs approved, give them an option that gives them about a 50% chance of a response. From there going on to a chance of a curative transplant. And of course, the docs are going to take that. And this year, when they originally launched the drug, they thought patients would be on the drug maybe 3 to 6 months top. And now the management has come out and said that treatment duration is going to increase to 6 to 12 months as they treat earlier and earlier line of patients. Before, the transplant rate was around 15%, meaning 15% of those patients go on to transplant. And now it's looking like a third of them will, a much higher number as they treat earlier line. And so now it's approved for NPM1, and people are concerned about competition. There's Kura Oncology, KURA, which I recently sold for about a 50% profit, still a great company. And they have a second menin inhibitor that could be coming to market with its PDUFA date, the 30th, 31st, a much cleaner safety profile. But my caveat there is some of their single agent data is, from what I've seen in the press releases and such, is missing. They tout the combination profile for earlier line AML. But when I compare, it's cross-trial comparisons, so you have to be very, with those caveats, it's not head-to-head. Right. But it looks to me like Syndax has a more efficacious drug. They're already in NCCN guidelines. So when these AML doctors are looking up the treatment protocol, this is where they'll go. They're already familiar with the drug, Revuforj. And so even if maybe the Q3, if scripts go flat in the KMT2A launch, that first small segment, my bet is that in 2026, scripts will start accelerating again as they launch into that second indication. And a really fun part here is one thing that's not included in analyst models, I believe, is after a patient goes on to curative transplant. Remember, we said about a third of patients do that. I saw a doctor survey that between 80 and 90% of doctors plan to put their patients back on Revuforj in the maintenance setting as well.
So that'd be a maintenance setting kind of indefinitely as administering it instead. So you talked originally 3 to 6 months. Now this would have a, and then expanding to 6 to 12, this could be 12 plus at that point, and that's a revenue stream.
Well, exactly. And what's also fun here is they have a second drug called Niktimvo, which was approved in the third line plus graft versus host disease. The comparator is Rezurock, which in its third year did annualizing 500 million of sales. And Niktimvo is already on pace to either equate that or pass it. And 50% rights are owned by Incyte. And so that larger partner, Incyte, you would think at some point will want to buy out the full rights. So again, it's just a really nice sum of the parts story. It kind of mirrors my approach, where I want to be in situations where heads, I could win big, and tails, the loss is manageable. Full transparency, the stock price is around $13 now, and my cost average is $9. So I don't want to not disclose that.
Yeah, no, look, I think it's important. You bring on a couple of things. One, I think, and correct me if I'm wrong here, or if this is characteristic of a lot of other your picks. You're focusing on a company that, one's got approved drugs, so you get rid of the FDA risk. They're scaling into markets that have the standard of care treatments, or the life expectancy is not very encouraging. So there, even if you can have it show a little bit of a benefit, you're more likely to scale into the markets with sales. Because look, I mean, all of us face this, right? If you had, you're in the unfortunate position of 3 to 6 months to live, and someone said we could double that, you're going to absolutely try that if you know it could be safe. Do you tend to see that you're focused on investments that are in those types of situations where there's not many other approved drugs that are working, and/or there's recurrence, and that you need some, they don't have any other options?
Exactly. That's the, I think it was Warren Buffett who said, and obviously he had nothing to do with biotech and risk, that would be too much for him. But he said having those hurdles, step over something as small as possible. And that's what we try to find in biotech too, maybe indications where there's nothing approved or very few options. Because the converse is true in biotech, that in oncology, for example, there's many indications where there's so many approved drugs. The treatment algorithms are so complicated that it's very difficult as an investor. Like non-small cell lung cancer, they're looking at what targeted actionable targets are there, what mutations do the patients have, will immunotherapy be an option, or chemo? It's just, there's so many variables out there that we try to focus on those indications where it's a lot more obvious.
So Chad's admittedly getting greedy here. You shared one good one, SNDX, for anyone tuning right in. He wants another one from you. Chad, just buy the XBI. It'll all be good. Now, what else do you like at these levels here?
Well, I love what you said about the XBI, and I'd be remiss that I like to tell people in chat, like, if you're trying to tiptoe into biotech and you're mainly doing XBI, but you want to have some fun in a disciplined manner, maybe your main biotech exposure is XBI and you own a handful of individual companies. So that way because sometimes the best way to learn is by doing it yourself, but that way you're doing it in a risk-adjusted manner. If you do well, great. And if not, you're going to live to fight another day.
Right. So do you find yourself, do you have cash holding, or do you just put it in XBI since you're all in on biotech and that kind of serves as your cash?
For me, it's all our holdings. So I'm allowed to hold between 10 and 15 positions at any given time. I've personally found that's my sweet spot. Back in the day, I tried to run 2 portfolios at the same time, and that's just diversification. You're spread too thin. And so, I try to focus just on what I know well. I like to say that I don't have many really good ideas. So when I do, I want to be long them.
Yeah, no, that makes sense. I completely concur. I find, especially in a sector that can get so specific, going over more than 10 positions gets really cumbersome to keep track of if you're doing it all on your own. Another question here. So Gain Therapeutics, I don't know if you've ever looked at this, but looks like they may have the first disease-modifying drug for Parkinson's. Have you ever looked at this? I'm going to let you answer, but I already know the answer. This is a phase 1 going into phase 2, so that's a hell no, not yet.
Yeah, I can't say I've heard of it, but I very much appreciate it. Like I said, that's the fun thing about chat, whether on X or wherever you find communities, being able to bounce these ideas off of other people. There's a problem on X. I think a lot of people, there's some accounts that tend to block if somebody disagrees with you. And I say the opposite. I love it when people tear into my ideas, tell me where I'm wrong.
Yeah.
When I started writing on Seeking Alpha, the comments were absolutely brutal. I'd have doctors commenting and being like, you have no idea what you're talking about, but that's how you get better.
No, I agree. And that's why I told people early on to read Adam Furstein over at Stat News, because he tends to be the most skeptical because he's been around for a while and read it all. And, he goes after people, attacks them, attacks companies. In fact, I pulled up a ticker in preparation for this episode. I don't know if you ever looked at it, Northwest Biotherapeutics, NWBO, that I've met with Linda, the CEO, back in 2009. And I mean, that feels like an eternity ago. I don't know how this thing's still around, but there is a rabid fan base, loyal fan base for a lot of these early stage ones that sometimes, as long as it's civil discourse, I think it's helpful. Gain, though, I would say here's the difference between you and I. I like the earlier stage that could be disease modifying companies that might not even get a chance to get approval, just because I don't focus exclusively on this. I think my diversification and risk management is by holding a handful of biotechs and then other names that are much less risky. Sure. So I guess, how many times have you had a buyout happen for these companies that you've been involved with? I mean, let me ask this a different way. At what market cap are you typically getting invested? Because I think that is helpful to people to understand, okay, I should wait until you're over a $500 million market cap or $1 billion market cap before considering it.
Well, the absolute minimum we're allowed to invest in, and it doesn't happen much, but is 100 million.
Okay.
Lower than that, no. I'd say on average between, that 500 million and 2 billion sweet spot. What you were talking about, risk management, especially these earlier stage companies. And I think a tweet I shared, a post on Jose Reston, who had the big win in RNA today. And what I loved is that he focused the attention not on his win, but on the risk management, saying that his first thing he looks at is downside cushion and what would he lose in the worst case scenario. And I like to think of that as winning by not losing. And so
Amen.
People who want to get into biotech, I'd say that's the first thing is first you estimate downside cushion, but also be aware that you could be wrong. So in the worst case, if it's 2% of your portfolio or 5% of your portfolio, ask yourself, if you woke up to the unlikely gut punch landmine that you lost 90% of your capital, how would you feel?
Yeah. No, I think it's instructive too, especially in this market where everyone's talking about all their winnings in AI and crypto. And then, a couple of weeks ago on Friday, we saw those people get obliterated as the altcoins got blown up. That's happened in biotech before. You want to avoid that. Question for you. Do you use or any, you talked about Warren Buffett earlier, doesn't invest in biotech, but are there any institutional investors that you follow for potential idea generation where you see them get involved and you say, oh, maybe that's a name I should take a look at?
I like to say that those funds, it is fun to follow the filings they have, but it's just one of many, many indicators. You have to remember that many of these funds, whether they're $1 billion or $10 billion in size, so you could read in an SEC filing that they own 10% of a very small biotech company. And for you, you're thinking, wow, they own 10% of them. This must be going to the moon. But remember, for them, that might only be 0.5 or 1% of their portfolio. So they know what they're risking. If this is a 10 bagger, great, they do well.
Right.
And if it implodes, they're going to live and fight another day. So make sure you take that into consideration.
Yeah, context matters. So I'm going to put you in the context of part of the interruption. We've got a few rapid fire ticker symbols here. I'll take some of them if I know them as well. So that's not you just in the firing line here, but we'll let the guys at the studio pull them up. If you know them and you have any opinions or you just want to say pass or abstain, it's all you. Processa Pharmaceuticals. This is an earlier stage one for me that's turned into a crypto treasury company. I saw Patrick Lynn at LD Micro. That's a pass in the context of biotech. They're not commercializing anything biotech now. They've turned into crypto. And it's way too early for Jonathan, so I saved you on that one. You got the next one.
All right.
How about SANA? Are you on board?
Well, interesting you mentioned that. Dr. Stephen Vig, who's actually, I saw one of his questions earlier from you. He's watching us. in our chat, he shared about this potentially curative therapy for diabetes. And as you know, it's too early stage for me, but him and a number of other guys in chat really like it. The initial results, it looks like they're solving
So
for
type
problems
2 or
that were
type
encountered.
1?
That's a good question. I can't say I've done the.
So
the
I'm
due
intrigued
diligence there.
now, doctor, because I was involved in Prevention Bio, which had the first disease-modifying drug for type 1 diabetes that got approved and then bought out by Sanofi. So stay tuned, tune in. I will take a look at this one and see what I think.
We have a YouTube segment where Dr. Vig also explained the mechanism and how it works too. So that should help you get up to speed.
That's awesome. Okay, next one, LCTX, Violator 2020. Back with this one.
Lineage Cell.
I don't know this one.
I remember it off the top of my head, but not.
$400 million market cap. So it hits on those levels. I'll have to dig in. We'll have to do some
GA market, I remember, which was quite big, but otherwise, I see that 36-month data. I know in GA, there's already 2 approved drugs that are suboptimal, but again, not familiar with this one.
All right. Do we have any more tickers to challenge us with? Koya
if not, I can.
I'm going to tell. Look, stay tuned. I know Koya well. Could be talking about it here in the future, but it's too early for Jonathan. We're saving. Look, I want to give you a chance because they're throwing all these ones at you.
Sure.
We definitely have some speculators in our midst because they like their early stage early clinical. I wanted you to give you a moment to talk about, because your community, the ROTY community, and what a subscription entails, because I've already heard things like a 500 member community that's really proactive about sharing information and intelligence that includes everyday investors as well as doctors and clinicians. You talked about YouTube content where you're doing interviews and sharing stuff. Why don't you tell me why I shouldn't sign up? Because for me, one single winner in biotech from you would more than pay for the subscription fee.
Hey, I appreciate it. I like to say that, as investors, one of the very few things you can control is the costs that you pay for your services, tools, et cetera. And you want to keep those costs as low as possible so that that's not eating into your account. So it really has to be getting the most bang for your buck, whether it's charting services or news or biotech, you name it, another person's portfolio, chat. So what I like about our service is there's a 2-week free trial. I always tell people to, kick the tires, copy anything that helps you. I have all my winners and losers, what I learned the hard way. The portfolio, the thesis for each company. Each weekend I publish a recap, a summary, including 5 names that I think are buyable or actionable right now. And so, only stay if it adds enough value for you. And if not, hopefully you take away something that helps you.
Look, I'm going to strongly encourage people to sign up for your service. I'm going to sign up today because I've realized how much you know. I've seen it, the value you add. You're very giving. And also, I would tell you, you don't charge enough. If I looked properly at what was the subscription price, I used to run a subscription service that was much more expensive, and we did not deliver as much value as you clearly have. What's the best web-based way to subscribe coming in from Chad Towers? They can find you at Seeking Alpha, right? That's where you run your subscription from?
At Seeking Alpha, you can do it whether on your normal computer or on your mobile. They have an app, etc. Somebody's posting there.
Yeah, it's Chad saying SANA was an Eric Jackson pick, so we'll have to dig into that some more.
If he wants another idea, I can throw another out there because they were asking for it.
All right, go for it, man. You got it. We're going to end with a bang, and this is a third pick from you, so you're delivering more value than expected.
Okay. Replimune, REPL. If you look at the stock chart, it's currently at $9. We just bought it at $8. And this is the company that the FDA just accepted their BLA resubmission. April 10th is the approval date. So I do caution people that it is a clinical stage company, but it is trading at around half of conservative peak sales for the lead indication in melanoma. And that's been my sweet spot in the portfolio, is buying companies when they're trading at enterprise value of 1 or less than 1 times the conservative peak sales. And then as a call option, you're getting expansion from there into other types of skin cancer, other solid tumors. But first things first, they need to get approved in this beachhead indication. This is a revaluation idea. So as we get closer to that PDUFA date, in April, you would expect the share price to run up some. If it runs to mid-teens, that would be a good time to take at least partial profits off the table, and then you could hold some into, in my case, it's a multi-year time frame. I'm looking at approval, sales growth, but each to his own, depending on how you want to manage the trade. But I feel like it's in the early stages of a revaluation upward.
Listen, man, I can't thank you enough. Nothing but a value add perspective, also specifics. Would love to have you come back on on the show in the future to share more with us, Jonathan. Thank you again.
Appreciate it.
All right, folks, stay tuned. You had some other questions about names that I know well, and I'm going to get into the diligence process that I use to find biotechs or compelling biotechs in this market that, funnily enough, mirrors a lot of Jonathan's, except for the stage of the drug development. So right after this quick break, we'll get back to dive right into that. But before we go to that break, please go to our YouTube page and subscribe so you never miss an episode, and go to our Twitter page to follow us. Sorry, I'm never going to call it X unless Elon Musk follows me. If Elon Musk follows me, I will start referring it to X and X posts as opposed to Twitter and tweets. So we'll be right back with that thought.
Onshoring of manufacturing is what's going to drive the job, I think, Phil.
It's the supply side incentives in the Trump agenda, which were huge the first round, and they've got to be as big this second round, I think, to help cushion the blow of AI.
Here's where they clash, though. Look at the gubernatorial race in New Jersey over electricity rates, right? You have AI competing with Main Street for resources, and this is where these policies intersect, because you had too many years of green initiatives that drove up costs, and now AI is looking as the enemy for competing against electricity costs. So I think that there's a cross-section.
In blue states, they're artificially keeping those costs high because they're still investing in
100%.
their idiotic policies.
Yeah.
So if they could work around that, people would find a lot of relief, which is one of the things Chitterelli is running on.
All right, we're back with a new segment, Lou Diligence, because a lot of times I just share the insights from my youth. Go Gadget, Inspector Gadget. I think we've had some other references that many of you probably don't understand because you weren't born yet. But anyway, we're going to spend some time today. We're going to bring in Dodman to go through what I look at and how I look at researching new opportunities. And in this segment, the first one, the inaugural one, we're going to cover the biotech sector, how I go about thinking about the sector overall as a whole, how much it fits into my portfolio, how do I go, more importantly, about finding new opportunities. So without further ado, let's bring in the questioner-in-chief, Mr. Dodd. How you doing, my friend?
Questioner-in-chief. That's a new title.
Yeah.
It's better than, intern you keep in the corner. So that's good.
Listen, you had a metamorphosis between the last episode and this episode. Now you're questioner-in-chief.
Beautiful.
So,
that was beautiful.
Biotech. Look, I can't say enough. We had some great comments here, I think, too. Let's bring them up because Jonathan was an amazing guest. Just the humility. Awesome. I mean, and then just his knowledge. Like, I don't think people understand. Q&A is on point today. Thank you, Chad. You're always on point with your engagement, man. I got to thank you. Oil and prop and drugs. Let's mix the two and swim in the money. I like this way this guy thinks. I don't want to be swimming in crude oil, though, but I'll be swimming happily in crude oil profits. But no, listen, this is what I think the point of the show is. Join this conversation, have some interaction, get some value, bring on guests that share value. We share value, but then it's also collaborative with the audience. So please, if you're still tuned in, listening for new stock picks and ideas, got some questions along the way, don't be shy, right? Fire away. Speaking of which, you got any questions for me to kick this segment off?
Well, you do your own analysis, and we've been doing this for many years. And, I've always asked you, like, Lou, what do you do? How do you research these, companies? So, I'd love to hear, your take on, looking at a new company. You heard several names today. You've mentioned, I got to look into that. What do you do first? Like, what do you jump into and what do you look for?
Yeah. So the first thing, and this will tie into, I usually have about 5 or 6 criteria that are kind of initial screens when I'm looking at a new biotech company. And Jonathan hit on one of them is, what is their cash runway, right? Cash matters, especially for biotechs, because they don't generate any revenue, not the ones I'm looking at. Jonathan looks at things later stage where they're commercializing. So they have approval and they're starting initial sales. So they presumably have more cash. I think he talked about SNDX having about 500 million in cash. I can't remember the last biotech I invested in that had 500 million in cash. They weren't even that big in market cap. So I try and find them that have at least 2 years of runway, right, to get them to an inflection point. If it's not 2 years worth of cash to keep them in business, it's at least enough cash to get them to the next data readout, which would help them raise cash. So I think the other thing, look, I think biotech can be really intimidating in the chart we're showing on the screen. For me, the way that I've looked to narrow down the list is see where the big tech companies, this is no different than when we invest, big pharma companies, this is no different than when we invest in big tech companies. Who are they buying, right? So Novartis out today with an acquisition of a RNA biotech. The ticker on this was actually RNA for Avidya, but here are other pure plays that are in this space. This would be my short list where I would start doing my homework on potentially other opportunities, because this is what I've noticed about mergers, right? They continue to accelerate. When someone goes and buys the #1 compelling drug candidate biotech, that means the other competitors to Novartis are going to be looking for the #2 and 3 and 4th most compelling one, right? So there's this competitive tendency, right? The urge to merge increases because, I mean, think about the head-to-head wars right now between Novo Nordisk and Eli Lilly for weight loss drugs, right? They're trying to one-up each other with a pill format or, you know, various trials in combination. So anyone innovating in that GLP-1 space right now is going to become a prime acquisition candidate. And Jonathan talked about that. Do they have strategic value to an acquirer? What I've noticed historically in 25 years of doing this is you got to invest in a hot area of the market, because if you invest in an area where the big pharma companies don't care about, you're not going to get good premiums, right? Like, they're not spending money, so there's not much other investment dollars that are flowing there. You're basically, it's the good old adage, you know, a rising tide lifts all boats, it lifts all stocks. If you're investing in the opposite of that, you're putting headwinds in front of you instead of tailwinds behind you.
We got a question here.
All right, Charles Stein, IOBT narrowly missed phase 3 melanoma, did well with some subgroups, but FDA told them not to file. They're talking with Europe now. Lost cause, or is this hope? Now, full disclaimer, I don't know IOBT. I will say this, the FDA is not always right. Europe presents another opportunity. I have seen companies that get European approval first and then expand into the US. I will tell you this, though, it's very telling if the FDA tells you not to file for approval, right? If you look at the phases, and this brings up another thing, Dodd, that you know, how do I do my research? You have to think about the stage of each drug, whether or not they're compelling, and how much risk is involved with it, right? So the chart we're showing on the screen is how much value gets assigned to each phase. So preclinical is before you even test it in patients. Phase 1 is the first phase, a very small group where you're just trying to test for safety. Will it keep people, will it not kill people, right? Then phase 2 gets into, does it actually work? Does it do what we expect? Phase 3 expands on phase 2 and says, hey, we proved in a small population that it works. Now let's prove it in a big population. So as you looked at that chart, basically what was happening, and still to this day in this downturn in biotech, is no one was giving any value for the preclinical and phase 1. Now it's really just everyone's not giving any value to the preclinical because it's the most risky. So you really want to focus on the later stages, right? So phase 1 readouts, that is a good, I like to see a company that's towards the end of a phase 1 readout, because phase 2 in certain indications could be ones where you apply for approval, right? So this is something people don't always understand, is that you think you got to go through phase 1, 2, and 3. In indications where there's not many treatment options, you can go right from phase 2 into approval. So you see acquisitions happen on really good phase 1 data or interim data in phase 2. So that's really where I focus. So again, cash. Is it a hot area in the market? And then also, what stage of development is it at, so that I can invest at a lower valuation that could get very high rapidly on an acquisition? And that's, for me, is tend to be end of phase 1 and beginning of phase 2.
So how risky do you want to be versus how long do you want to be in it? You know,
right. So it's exactly right. So I'd say if you're a risk taker and a speculator, you want to get some biotech ideas from me, because I tend to focus earlier stage. If you're risk averse, then definitely sign up for Jonathan, because he's waiting until approval. So he's taking all that risk out of the equation and saying, I just want to find companies that have drugs that are having really good efficacy and then could treat a lot of patients, right? There's not many other options. So he's more of a commercial play versus me as a scientific development play.
Well, you know, Jonathan gave some great names there for our viewers to take a look at. Do you have any names that you want to talk about?
Yeah, I mean, look, two got brought up. Gain Therapeutics, I think, is they reported some interim data where they're actually showing treatment and efficacy in phase 1, right? So a lot of trials now are phase 1 are designed to maybe get some indications whether the drug will work, not just if it's safe. They put out some data it's the motor skills. I can't remember the exact acronym of the conference, but showing for Parkinson's disease some really encouraging data. In fact, we just sat down and did an interview with the CEO that we'll be releasing soon that gets into more of those details. But I think this is a company that we shared before could really change the trajectory of treatment in Parkinson's. You know, in this interview, the CEO, Gene Mack, shared that Michael J. Fox, who is probably the most well-known person that suffers from Parkinson's and has been very instrumental in helping fund research, made an appeal where he's like, look, it's been 20 years. Where are the therapeutics? Like, he started 20 years ago investing and trying to catalyze development for treatments here. So I think this one is poised. If they show continued efficacy, is going to get bought out by one of the bigs because it's an area where we don't have any treatment options.
All right. And the, you know, obviously we've been talking a lot about biotechs, you know, picking up just like small caps. What is are you still obviously bullish on, you know, on biotechs now, but what about ETFs? I know we talked about one earlier. Is there any other ETFs, or is it really kind of one main one that you kind of stick with?
Yeah, so there's two main conservative ones, and then there's a third one for all the degenerate gamblers out there that we talked about a few episodes ago. So the main ones, yeah, get your pen for the degenerate gambling. You play slots, so like this fits your bill too, right? Like slots are the worst odds in the house, my friend.
Anyway. You just played slots, don't lie.
I didn't play slots, but one of the members of our party played slots and he won $18,000. So I guess maybe sometimes it works out. But here's the ETFs, right? IBB is the biggest biotech ETF. It's like the S&P 500 of biotech. If you want exposure to the biggest names, which now really trends towards more big pharma companies, IBB is the way to play. If you want to get exposure to the smaller names, the more innovative companies, you use XBI. Right, so XBI is not market cap weighted, it's equal weighted, so it spreads the bets out across smaller companies in the space, so it skews to much smaller market cap names that have more room to run. If you want to be a degenerate, you buy the LABU, LABU, I believe is the ticker. It's the 3 times leveraged ETF on the XBI. So if XBI goes up 10%, LABU should go up 30% in theory. There's some slippage there. Yeah, the S&P Biotech Bull 3 times shared. I would just universally warn against leveraged ETFs. There's never been more in existence than now. I think there's over 700, I think was the stat that I saw, which is insanity. This is a great way to blow your portfolio up if you go too heavy into them. So if you're going to be a speculator, position size, like Jonathan said, right? Take maybe a 2% or a 3% position in one of these ETFs so that you can't blow yourself up. Because remember, if the index goes up 10%, 3 times leverage should go up 30%, but it cuts the other way. If the index goes down 10, you're down 30%, and it's a lot harder to recover from a 30% loss than it is from a 10% loss.
Makes sense.
Yeah.
And last thing, you know, Jonathan said some great things, but diversification, great word, love it. And
yeah, I can't remember who termed that originally, but yeah, it happens. Like,
he didn't invent that, because that was great.
No, he didn't invent that. Look, as he said earlier in the interview too, he's not really had any original thoughts. He's sharing what he's learned in the community. I'll confess, I don't have any original thoughts either, right? I think they are at sometimes, and then my wife reminds me, no, someone else said that. You're not that smart. So. I'm kidding, honey. Don't get mad at me. You've never said that to me. Full confession on there. No, look, diversification, I think, is really a great way to think about this, is when you get too many names in your portfolio, like today alone, right? We've got an REPL, SNDX, SANA, Cura, Insight, XBI, IBB. The last thing you should do is go out and buy all of those. You should spend time to maybe buy 1 or 2 of those, because it's just too much to keep up with. And if you spread your investments too thin, well, then the one that really wins and goes big, it just doesn't have enough of an impact on your bottom line. So I've always traditionally had maybe at max 10 positions at one time. Sometimes it creeps higher than that if I look at some bigger tech names. So I advocate over quality over quantity.
That's 10 across the board, not just biotech. That's everything.
Yeah, 10 high conviction names across the board. I put we talked about this in the previous episodes where 70% of my investments are in low cost ETFs, asset allocated and diversified to make sure that my future goals are met. And then the other, call it 30 to 40%, are in, no more than 10 names at once that I'm trying to improve the quality of that retirement or accelerate the growth of the portfolio. So as Jonathan pointed out, right, if I have a blow up in that section of the portfolio, it really doesn't undermine and ruin me and bury me where I can't recover from that loss.
That's smart.
Make sense?
Makes sense.
All right, so a couple. You approve. That's good. The other thing I asked Jonathan about it, and I think he made a very good point about following basically the Warren Buffetts of biotech. There are some very savvy investors, institutional investors, that I think can help narrow down the universe of potential investments. People like the Baker Brothers, Perceptive Advisors, Orbimed. Those are three main names. RA Capital is another. They have a history of being early and right and very successful in the biotech space, but context matters. Looking at how big of a position they take in a name can tell you how much conviction they have. So it's not just enough to look at do they have a position in this company? It's how much of their fund is invested in it. Chad winning the medal for the most questions and feedback in a single episode. We need more Chads. Can we clone Chad? I picked up SNDX, REPL, and double down and take another position in ADMA and add to my Santa. He's an animal, folks, and he's got oil profits on the way and prop. So I love the participation. SNDX, Jonathan, sticking around for the conversation. I love this too. Number 4 position, 10% of his portfolio. This is great. I mean, look, I've seen his content, and one of my just lifelong investor friends that I met is a subscriber. I need to go be a subscriber because the value add he's contributed in 60 minutes of this day alone is worth a subscription price. Folks, I never, and Dodd, you can verify this, I never advocate for signing up for someone as much as I have for Jonathan because I'm impressed by his story, his humility, and the results and his willingness to just keep sharing.
Absolutely. The fact he shared a bunch today, and it's not even, a lot of folks will say like, give you one and go to my page and pay for the rest. But, Jonathan's just, but community, that's what he talked about, and that's awesome.
That's what we're trying to create here as well. And guess what? We're oversharing because we only got 2 minutes left in the show. We got a high five, so it's going to be rapid fire, part of the interruption style. We're going right into the Dodd block where you control the controls in this segment, my friend. So get after it, or the bell's going to ring and we're going to get knocked out without going through our content.
Let's do it. Let's do the high five.
All right, I think we got one more comment from Chad because he wants to put the pressure on us to see if we can get everything done in a minute and 30 seconds. Your community is blossoming, guys. Great stuff. All right, man, we appreciate you. We didn't pay you to say that. Awesome today. Thank you, man.
You did say we need more Chad. So
we do need more Chad. So Chad, get your family, friends, and everyone you know to join us next week's episode. We'll be bringing, I don't know what yet, but maybe not precious metals, rare earth minerals, critical minerals. That could be a topic of interest that is getting a lot of headlines now.
We'll find out Sunday night. So it's all good.
Let's go. I think, are there rare earths in meteors? Do you know about that? You're the space guy. You believe in aliens. I don't. Anyway, let's get to the rundown. Fast, the high five.
All right, prepper's pain.
Prepper's pain. Everyone's been prepping for a recession. It ain't coming. The latest data coming out from, I think this is B of A's global survey of fund managers that proves they're insane because 1 month they think there's a 40% plus 40% chance of recession. A few months later, they say it's negative 40%. So if you hear anyone prepping for a recession, more money, as Peter Lynch said, has been lost preparing for corrections and recessions than has been made waiting them out. So just stay invested.
How do you prepare for that? Is that just put some money on the sideline? Is that
take cash out of the market? You're basically a glorified market timer that ends up not knowing when to put the money back in, so you lose out.
Gotcha. All right, Google it.
Yeah, that's right. Google it. We've been saying for a long time here that Google was going to outlive the naysayers in AI. This is now the most profitable company in terms of net income. AI is not going to eat Google's lunch. They're going to be a dominant player here. Stocks rebounded from a low in April of about 140, well north of 200. And I think they report results later this week, Thursday, Wednesday after the bell, Thursday. I think you're going to see new all-time highs on the heels of that. Google it.
You've been super bullish on Google forever. I look at, Google stock price, and obviously it's more intimidating for me that, it's a higher price, to put money to work in Google, would take a lot more. What's your opinion on that? Is it like, for a newer investor, do you put a little into it
price is just a number. 200, like, can it go from 200 to 500? Yeah, just as easy as another stock could go from 2 to 4. So yeah, I don't think you worry about it. You find good, fundamentally sound companies that are growing earnings rapidly, and the stock price is going to go up. So stop being a chicken. Buy.
So you're saying Google's going to 500, right?
I think Google could double from here.
All
Market.
Right.
I said it. Yeah, earnings cube, nothing but positive surprises. We've been banging this drum for way too long that earnings have been stronger than expected for the last 2 quarters. Third quarter, we're only about, 20% in. 45% of companies report earnings in the S&P 500 this week. I think you're going to see this trend as our friend. Over 80%, I think it's at 83%, have beat expectations. Folks, when earnings keep increasing, stock prices do too. This is a well intact trend that's going to keep continuing well into year end.
I'm hoping for a great in November and December. Let's do it. Tech Rec.
Yeah, Tech Rec. I think everyone's waiting for the hippopotamus to fall on them and just smash their profits here. Because honestly, I just don't see it, because everyone's warning in the headlines and the financial press, but the institutions and money flowing into tech funds is just going up because everyone realizes the earnings are growing. This week, here's where I think is critical. We're going to start getting the Mag 7 reports. We got Tesla already, but I don't really think of them in the AI sphere. But you're going to get the Alphabets, the Microsofts, the Amazon, the Metas of the world. As long as they show that they're not taking down their estimates for AI, more importantly, that they're increasing their investments like they have for the last 2 quarters, this tech rally is going to keep going higher from here, despite everyone saying it's the next .com bubble, it's happening. Again, you're never going to know when the top is. There's no prize for predicting the top, but there is a prize for staying invested.
Why is everybody picking on big tech? Aren't they carrying the S&P 500 still? I mean,
they are. And look, everyone wants to, their earnings growth has decelerated from about 30%, 25% to 14% in the most recent quarter, but that's still double the rate of the other 493 companies in the S&P 500. So as long as they keep growing earnings by double digits, they're going to keep propelling this market higher.
Good deal. Energy errors.
Yeah, look, we talked last week. We focused nothing but on oil and the rebound that is imminent, right? And when I say imminent in a commodity market, it usually means within the next 6 months. But sure enough, record short interest betting against oil prices. Folks, when everyone thinks alike, everyone is likely wrong, or everyone's not thinking, whatever popular phrase you want to use for being a contrarian. And here you see a record short interest position in Brent crude prices, which means, I think, as we exit this year, you're going to start seeing crude rebound and rapidly, and that's going to benefit not just my employer. This is not a shameless plug for the fact that I work in the oil and gas industry. This is more of a shameless plug for the XLE, the ETF, the energy ETF that should rally pretty strongly on any increase in crude prices.
Yeah, Chad just texted me. He just said, where is Prairie stock price going to go up through the roof?
I can't answer that question. That could be material non-public. No, I don't have a crystal ball. I just know that I'm involved with the company because I believe in the long-term value and the ability to roll up income-producing assets and then return that to shareholders. So I think I will look back 2-3 years from now and not be mad about my decision to join Prairie and be invested there as an investor as well.
All right. Good deal. I think we have one last lose clues. Let's.
Yeah, it's going to be the last one because this was just too forced today. It was just too cheesy. I got them worked in, all these words. For people that know, you give me 5 words I have to work into the conversation naturally. I don't think I did it naturally this week. I may retire this.
You failed one time, and now you're going to retire it.
I got all of them, dude.
See, yeah, I don't know. See? I'm going to have to go back and watch the tape again. I didn't
listen,
hear 5 dings.
You go back and yeah, I did. There was 5 bells coming up on Christmas time here. We're getting ready for the bell season. But look, we'll come up with new games, except the is it crypto or crap, which made me uncomfortable, man. Right. I can't give you free reins on that. So
you want to scrap lose clues? I'm coming up with some new games. You're going to be regretful.
That's the reason to tune in next week, because Dodd might have new games. He's probably going to have some more great questions, and so are you. We encourage you to join us every Monday at 5 p.m. We encourage you to follow us on YouTube and X, and we thank you for all our loyal listeners and first-time listeners. Don't be afraid to chime in the next episode of The Big Skinny. I'm Lou Basenese, signing out.